So there's a big change happening at the top of India's central bank, and it's got everyone asking one single question. Are we about to see interest rates get cut to kickstart the economy? Well, today we're going to decode the RBI's next move. And let me tell you, the answer is probably not what you're expecting.
First things first, we've got a new governor at the helm of the Reserve Bank of India. Now, anytime this happens, it gets people talking, and this time is absolutely no different.
And this is the million-dollar question, isn't it? It's on the minds of everyone, from business owners to anyone with a home loan. And on the surface, the answer seems kinda obvious.
The conventional wisdom, the story you hear a lot, is that a new governor, especially early on, wants to get on the same page as the government. And what's the quickest way to do that? Cut interest rates, boost growth. But is that what's really going on here?
Okay, so let's push past those easy assumptions for a second. Because when you really start to dig into the details of the situation, you find that things are way, way more complicated. The new governor might not have nearly as much freedom to act as people think.
The truth is, right now, the RBI just doesn't have a lot of wiggle room. And this isn't about them not wanting to act. It's about being stuck between a rock and a hard place with very few good options. I mean, think about it. Every new governor walks into a totally unique economic environment. In the past, leaders have had to deal with things like the global financial crisis, demonetization, even a pandemic. The leader today is facing a very specific cocktail of challenges that are seriously boxing them in.
So that old rule of thumb, new governor equals rate cuts, it just kind of falls apart. You can't apply a one-size-fits-all theory when the facts on the ground today are so unique.
So if they're boxed in, what's the biggest wall? What's the main reason there's so little room to maneuver? Well, it all boils down to one very powerful word: inflation.
And that is the real hurdle. Cutting interest rates to boost the economy would be like pouring gasoline on the fire of inflation, especially with food prices being so stubborn. And controlling inflation, that is job number one for the RBI. They absolutely have to keep a lid on it.
With inflation as a major concern, you have to ask, how much could rates even be cut? Well, what we're hearing is that 1% to 2% isn't just a realistic number, it's pretty much the absolute upper limit.
In fact, what's probably more likely is a cut closer to maybe 1 percentage point. And even then, it wouldn't be all at once. We're talking tiny, careful steps spread out over a much longer period of time.
Now, yes, the economy is slowing down a little. But look, a 0.5% dip from a 7% growth trend, it's not the five-alarm fire some might think it is. To put it another way, this is hardly a rallying cry for the doves to swoop in and demand action.
And hey, speaking of doves, let's quickly define that. In the world of central banking, doves are the policymakers who are more willing to risk a little inflation to boost jobs and growth by cutting rates. The problem for them right now is that the data just isn't giving them the ammo they need to make that case. So before those doves can even think about taking flight, the RBI needs to see something called disinflation. That doesn't mean prices are falling. It means the rate at which prices are going up is consistently slowing down. That is the green light they are waiting for, and we're not there yet.
Okay, so if the big splashy rate cuts are off the table for now, what is the plan? I mean, what is the RBI actually going to do to manage the economy?
Well, this is where the real focus is shifting. While everybody is watching for what they call easing, those rate cuts, the real action is happening somewhere else, kind of behind the scenes. The RBI is putting all its energy into something called liquidity management. So what on earth is liquidity management? Think of it this way. It's all about managing the amount of cash flowing through the banking system day to day. It's not a big dramatic change to the main interest rate. It's more like a very precise, very careful fine-tuning of the financial system's engine to make sure it runs smoothly. And that right there is the big takeaway. Forget the big headlines about rate cuts. The real story, the actual game plan, is this subtle, technical work of managing the money supply to keep things stable. That's the priority. And really, this brings us to the core problem, the classic dilemma for not just the RBI, but for central bankers all over the world. When your economy is slowing down, but inflation is stubbornly high, what do you do? How do you support growth without letting prices run wild? There are no easy answers, and watching this delicate balancing act, that's the key to understanding what happens next.